All right, so we are in our discussion here on an introduction to accounting, which we said is primarily focused on things related to financial accounting. And where we left off last time was talking about these subledgers and the fact that we have subledgers for customer accounts and vendor accounts and typically for assets. The reason why I keep saying typically for assets is it depends on the nature of our organization, and if we don't have a lot of assets in our kind of business, we may not bother with subledgers. But we, in most organizations, are going to have customers and vendors, so those tend to be universal. Subledgers connect to the general ledger by way of reconciliation accounts. I guess one thing not on this slide that I would remind you of is that subledger is kind of a shortening of the term subsidiary ledger. So don't let that trip you up if on the test I use the term subsidiary ledger in places where here I just have the term subledger. A key thing to remember is that an account that is designated as a reconciliation account cannot be posted to directly. Instead, we post to the subledger, and that results in posting to the reconciliation account. And in all my drawing of diagrams last time, I don't know that I specifically illustrated this. Let's assume that this is the reconciliation account, which is a part of our general ledger. And then down here, we have various accounts that are in our subledger. And what is very, very common for us to do is to organize these accounts into account groups. So we might, for example, have East Coast customers and West Coast customers that are each in separate groups. And maybe this particular account group, every one of these accounts is posting back to the same reconciliation account, and every one of the customers in this group has its own distinct reconciliation account, because one of these could be, accounts receivable West Coast, and the other could be accounts receivable East Coast. We can do things like that if we are so inclined in our organization. So you see kind of an interesting scenario here where multiple subledger accounts all populate back to the same reconciliation account. And that's really the way this will typically play out, because we don't want a different reconciliation account for every customer. We want many, many customers to share the same reconciliation account in our general ledger. And what I have just illustrated here in my diagram is this idea of account determination. And so when we create a customer account, we will, assuming we're doing our work properly, we will configure the reconciliation account for that customer account. Now, there's nothing in the system that's going to keep us from shooting ourselves in the foot, which means that this customer right here perhaps should be populating up to this account on the left, but I accidentally put in the wrong information, and now I've tied it to a totally different account. Because these are both reconciliation accounts, that's fine. But what I can't do is I can't have just any old general ledger account and say that that's going to populate up to that. That's not going to work. The only kind of account that can be connected to an account in a subledger is an account that is specifically designated as a reconciliation account. Roger, you had a question? Yeah, the system, I don't know that that happens as frequently as you might think, but the system does have various controls in place to enforce data integrity. So yeah, if it just so happens that 5 salespeople push the enter button on a transaction at exactly the same time, they are going to go into a queue, and be executed in a serial fashion so as not to create problems. Yeah, remember, everything in this whole system is architected from the ground up to never let us lose information. And if we ever have a situation where we start dropping transactions like this, our double entry accounting records are going to be off, we're going to be out of balance, and the world has just been destroyed, basically, in terms of financial accounting. We can't have stuff like that happening. So yes, you can rely on the fact that although you could shoot yourself in the foot and tie these to the wrong reconciliation account, there's no way here that you could just cause things to disappear, go into a black hole, or just be processed incorrectly. So good question there. All right, well, today we get to do something very, very fun, which is we're going to dig into financial accounting. So for those of you that have taken an accounting course before, today will be quite a bit of review for you. For those of you that have not, today's the day for you to take really good notes and perhaps ask a lot of questions. When we talk about financial accounting, we are talking about engaging in accounting in what is called double entry accounting, which means that every time there is a transaction and we record it in financial accounting, we actually record two different things. There's actually two offsetting postings that happens. One posting goes to one account as a debit, and the other half of the posting goes to another account as a credit. And so that's just the way that financial accounting has actually operated for centuries. I have a good friend from many years ago who got his PhD in accounting. And PhDs in accounting are about as fun as you think they would be. And he wrote his dissertation on the history of financial accounting. And he went back and traced through history who came up with the idea of double entry accounting and how it's evolved through the years. And once again, as exciting as you can imagine something like that would be, but I mean, this traces its origin back hundreds of years. This is the way that these kinds of records have been kept for a very, very long time. And I don't think we're ever going to see that change. The key principle to keep in mind, without exception, is debits and credits are always equal. So if we have a transaction that's a $200 transaction, you're going to expect to see a $200 credit somewhere and a $200 debit somewhere. And keep in mind, $200 transaction results in two $200 postings, not $100 and $100. And we'll work through the mechanics of specific transactions. I will say that the questions that I'm going to ask you on tests will very much resemble the exact scenarios that we work through together in class, because of the fact this is not an accounting class and a lot of you are going at this from a brand new sheet of paper kind of perspective. We will talk about a lot of different kinds of transactions this semester, but as long as you know the ones we're talking about in class and the ones you read about in your book, you'll be okay. So we said that there's this idea of debits and credits that go along with these postings that we do. Well, different kinds of accounts have a different, if you will, native balance. An asset account is an account that has a debit balance, which means that if we debit an asset account, that's equivalent to saying we're increasing the value of an asset. If I credit an asset account, that in turn means that the balance or the value of that asset has gone down. So just to jump to one explanation of this, if I buy a vehicle and pay $40,000, I would record that in an asset account, and there would be a $40,000 debit in place on that account to represent the value of that asset. At the end of the year, perhaps I depreciate or lower the value of that asset by $2,000. To make that happen, I would credit the account $2,000, which would then lower the value of the asset from $40,000 to $38,000. So that's the idea behind the way debits and credits will actually work. The big thing for you to wind up having to keep track of here, and students come up with lots of different mnemonics or study aids to help with this, and maybe some of you would want to share those with your classmates as we go along here. But you're going to have to keep track of the native balances, if you will, of particular accounts. Asset accounts have a debit balance. Liabilities and equity accounts have a credit balance, which means that if I credit a liability account, I'm increasing the obligation. So if I go to the bank and take out a loan, and I now have a $10,000 liability that I did not have 5 minutes ago, that $10,000 liability is going to be reflected in financial accounting by me crediting a liability account for $10,000. So liability and equity accounts have a credit balance. Now, you had a homework question about this that most of you did well, but I don't know to what degree you understood it versus just writing down what you saw in your book. So I want to make sure we go through this. We typically, in financial accounting, illustrate postings using a T account. It's kind of just traditional. And whenever we use T accounts, the left side is always the debit side of the account, and the right side is the credit. Now, what often gets lost in this is that fundamentally what we do is when we figure out the balance of an account, we think in terms of the debits and credits being brought together. So, for example, let's go back to what I mentioned a moment ago. I have an asset. I buy a vehicle. And so it has its own account, maybe in our subledger, and it's car. And when I bought the car, it was $40,000. So I am going to say, okay, asset account has a debit balance, $40,000. Now that's the only transaction in this whole account. So this is equivalent to saying my car is worth $40,000. At the end of the year, I depreciate the car, which means I'm going to credit this account $2,000. And so I would write it like this. But we would also then say, okay, the value of this car right now is actually $38,000. We kind of bring together debits and credits when we're talking about the overall balance of the account. And so typically when you look at illustrations in different places, it'll show you the top part of this, but not explicitly point out the way you calculate the balance here associated for a particular account. We'll talk about how this is reflected in our ERP system as we continue on here. So any questions so far? Yes?
40,000, would it appear somewhere else in the...
Yes. What we said here at the top, where we said two offsetting account posting, this is a debit for $40,000. So there's another account somewhere that is being credited for $40,000. And what account that is depends on the logistics of this transaction. And that we will develop more as we go along here. But yes, anytime I'm making a debit or credit entry to one account, there is an offsetting debit or credit going to another account. So, for our accounts that are on our balance sheets, we said that assets have a native debit balance. So this is just an illustration of this. What would be examples of assets? Equipment, materials, receivables, money that customers owes us, for example. Accounts receivable accounts are assets. Bank accounts are assets. So right away you should be able to tell, okay, so that means that if I buy materials, I know I'm going to be debiting some kind of material account. If I put money in the bank, I know that I am going to be debiting a bank account to reflect an increasing value. liabilities and equity would be things like equity capital. Loans would be a more typical example that we will work with, or other liabilities like accounts payable. So when I go out and buy something on credit, and I now owe another company $5,000, we know that that's going to result in a $5,000 credit going towards some kind of liability account. So this chart illustrates the concepts that I referred to on the last slide. Here's another representation of the exact same information. I'm trying to give it to you multiple ways so that maybe you can pick out one of these that makes the most sense to you and use it as an aid in studying. So notice the first line. If I'm debiting an asset account, that means I'm increasing the value of the asset. If I credit an asset account, that means I'm decreasing the value of the asset. For an expense, if I debit an expense account, that means I've incurred more expenses. If I credit an expense account, that means I'm reducing the actual expense value. For revenue, if I credit a revenue account, that means I have more revenue. If I debit a revenue account, that means I have less revenue. For a liability, an increase in liability is reflected as a credit. A decrease in liability is reflected as a debit. And for equity, an increase in the equity value is reflected as a credit, and a decrease is reflected by a debit. You've got to be able to keep those straight to do double entry financial accounting. At some point, after doing enough of this, it just becomes very, very easy for you to classify and work with things in this fashion. But until such a time as you do that, this is something that can cause a good bit of headaches for you. Yes, ma'am.
The only thing I'm kind of confused about is like you said, a banking account is an asset, and so for my personal banking account, if I call and check my balance, yeah, it's back.
Yeah, it is. Because usually, I had a student in another class point out this. It's like, usually if you call up the bank, if they say, I'm going to credit your account $50, you're thinking, yay, I have $50 more. But in the context of financial accounting, if we credit your bank account, that means you have less money. Yeah, that's. Yeah, it's two terms that are the same word but mean totally different things because they're in different contexts. And so, yeah, you have to differentiate a credit, which is good for you, versus a credit in a financial accounting perspective, which is probably the exact opposite. So, yeah, if your bank wanted to be really mean, they could say, we'll credit your account, and that means you actually have less money than before. But that's probably not going to be a real customer-friendly way of handling that. All right, so I've given you a lot of facts. I think this starts making more sense if we start working through some actual transactions here. So here's a scenario. I go to the bank and I take out a loan for $10,000. And they give me $10,000 and I just turn around and put that in my checking account. So how is this recorded in double entry financial accounting? Well, first off, there's going to be two different accounts affected here. There's going to be my bank account, which is an asset account, and there's going to be another account, which for the sake of this illustration, I'm calling notes payable, which is a common financial accounting term. That could just as easily be called bank loan or loans or something similar. The wording isn't that critical, but it's the idea that the one on the left here is an asset account, the one on the right is a liability account. Now, what I have found in my own personal way of trying to remember this is if I can always remember that debiting a bank account means the value in the bank account has gone up, a lot of times you can then just kind of work from there. So in this scenario, if I just put $10,000 in my bank account, that means that I just debited my bank account $10,000. Well, if I know that I debited my bank account by $10,000, then I know that the offsetting accounting has to be a $10,000 credit to notes payable. And in fact, if we were to go back to our previous chart, we would see that debiting an asset account means an increase in the value of the asset, and crediting a liability account means an increase in the overall liability. Now, where have we seen this before? Well, let me just show you a couple things. I didn't log into our SAP ERP system, so let me do that real quick, and let's take a little bit of a minor detour here and show you where you have in fact seen this before. And we're using BK3 this semester, and so give me a moment to get logged in. When you played ERP Sim previously, you actually ran this transaction, and I've memorized, that's not the right word, I've memorized the transaction code because of ERP Sim, and I know that FB50 pops up this little transaction right here, which allows me to post transactions to my general ledger. Okay, so let's illustrate the exact transaction that I just showed you a moment ago. So I'll come here, and I got to put in the document date, and so I'll put it for today's date. And then I come down here, and on my slide a second ago, we said I got a bank loan, and I put it in my checking account. So I come here to my general ledger, and I'm going to go ahead and I'll do the putting it in my checking account first. And so I look at my general ledger account, and I say, okay, that's my bank account, and I'm just going to do $1 here instead of $10,000. Same concept. And what am I doing to my bank account to reflect an increased balance? I'm debiting my bank account. Well, then I have to come down here, and I have to have an offsetting credit. So now I've got to find an account that I'm going to use to record this particular loan in. And on the slide, I put notes payable. Notice here I have a whole set of different payables here, of which I have long-term and short-term notes. Let's assume, especially in this case, since it was only $1, that this is a really short-term loan. And so I'm going to use that account, and I'm going to credit it for $1. Now notice when I press enter, see these little traffic lights over here? They are going to make sure that my debits and credits equal. Well, for the sake of illustrating that, let's suppose I made a typo and I created for myself a really bad deal, which is I got $1 from the bank and I have a loan offsetting that $1 of $10. These are now out of balance. When I press enter, I have a red light. That's telling me this is not a viable transaction, and it will in fact not let me post this. If I try and save this, it will come back and say posting is only possible with a zero balance, which is its way of saying the way it actually does this is it treats it like a math equation, and it takes one of these numbers and subtracts it from the other and expects to see zero as the result. And clearly in this situation, that's not going to happen. So I have to look back up here and I have to say, oh, well, I'm an idiot. I mistyped it. That should be $1. Notice now I have a green light, and so now I can, in fact, post this to my general ledger. And so a lot of times when we're recording things in our general ledger, FB50 is a really handy transaction because it lets us do the debits and credits directly to our general ledger accounts that we might need to. Now, it would be extremely cumbersome if every accounting related to transaction had to be handled in this fashion. So sometimes when I ship materials out, when I sell products to customers, the accounting postings that go with that happen automatically behind the scenes without me having to go in and do this manually in the fashion we just did. Yes, sir. Roger. Absolutely. Hypothetically, I could have taken out I could have deposited in the bank. Well, here's a great example of that. Have you ever been to the bank to make a deposit and maybe you hand the teller 5 checks and they add it all up and they record it as one increase to your check account? Well, hypothetically, I could go to the bank and add $10,000 to my bank account and have 5,000 of it have come from a long-term loan and the other 5,000 come from a short-term loan. So I could have a $10,000 credit and a $5,000 debit to one account and a $5,000 debit to another account. But the key is debits and credits always have to offset each other absolutely perfectly. Okay? Great question.
So
Yes, sir.
In this interaction right here, if we were to put it all in there, so long as it all balanced out, it would be fine, no matter what accounts we apply.
Except we already observed previously that we cannot directly post to reconciliation accounts, for example. So there are accounts, and typically, at least in our chart of accounts, I believe you will find the word reconciliation show up in the names of the accounts. Let's see if we can find one here. Notice I have a lot of inventory accounts here that are inventory direct post accounts. That tells me that I probably have an inventory account that is actually a reconciliation account. So like here, transactions for raw materials, notice I have a direct post and a not direct post. This is a hint that these are probably reconciliation accounts and these are ones that I can post to directly. I'm looking to see, anybody spotted an account with the name reconciliation actually in the account name? I don't see any right here. We'll find some eventually and work with them, but like I said, it's not uncommon for reconciliation to be in the actual name of the account, although I'm not spotting any right off here. So yes, there are some accounts here that if I tried to post to them, I would be blocked because of the account type, would not be eligible for direct posting. Other questions? And we'll come back to that concept a little bit later and flesh it out further. All right, so another scenario. I go to Johnson Lumber and I buy $1,000 worth of lumber and I don't give them cash, I tell them to bill me for it. So I now have an obligation to pay Johnson Lumber. Well, how does this work? This is an example of where we use a reconciliation account. I know that my buying of $1,000 of materials is going to be reflected in a materials account. But my obligation to Johnson Lumber has to be recorded not just as a general debt, but a debt that I specifically have to Johnson Lumber. Johnson Lumber is a vendor. So what will actually happen here is my interaction will be with the subledger account. So the mechanics of this are as follows. The debit is $1,000 because I have increased the value of an asset. I have more lumber now than I had before this transaction occurred. My offsetting credit is to this account down here. You say, well, is that the end? No. Then, through account determination, this is automatically reflected as a credit to accounts payable. This arrow here is an automated posting. I cannot directly credit accounts payable. Because if you think about it, if I directly credit accounts payable, I lose in my record keeping the fact that I owe Johnson Lumber $1,000. So when I have a transaction with a vendor, the debit side of the transaction will always be reflective of what I just bought from that vendor. In this case, I bought materials, so I debit an account by $1,000. Maybe what I bought was something else, and so there might be a different debit on a different account. But that side of the transaction will always be going into an account that's reflective of the value of what I bought. The offsetting credit is to the customer account, or excuse me, to the vendor account. And then the system automatically reflects that in the reconciliation account associated in this situation with Johnson Lumber. How do I do this transaction in FB50? Don't. I can't. This is an example of I record through other transactions the purchase of these materials, and the system does the postings automatically through mechanics we'll continue to flesh out as the semester progresses here. Yes? That is correct. This is a reconciliation account, and this, as is noted already, this is the subledger account. Now, I think this link will work for me. Let's check. Okay, well, let's keep going for a second, and then we'll look at this. So now, some time has gone by, and it's time for me to pay $1,000 to Johnson Lumber to settle my account, to close my bill with them. So I know that I've got to make an entry here on the Johnson Lumber account. Now, what's not on my slide is the fact that coming into this, before I paid, I have a $1,000 credit sitting out here and a $1,000 credit sitting out here from when I bought. All right, well, now I'm getting ready to pay, so now it's time for the bank account to come into play. And in this situation, I'm going to be parting with money. When I part with money, I credit a money-related account, so I'm going to be crediting my bank account by $1,000. We don't know what the previous balance of my checking account was in this illustration. It doesn't really matter, but I now have $1,000 less than I had before. The offsetting entry then is a debit to Johnson Lumber for $1,000 that will be automatically populated by the system up to a debit to $1,000 for $1,000 in the reconciliation account. Now, if you look at this scenario, what has now happened is, over here, my accounts payable says, hey, you don't owe anybody anymore because these $1,000 cancel each other out. And my Johnson Lumber account reflects that I owe Johnson Lumber $0 because they cancel out. So if you think about what happened from a big picture view, and it's not all shown here, but on the other account we worked with a moment ago, our materials account, maybe I still have my $1,000 of lumber sitting there. So when all is said and done, I have a debit value for materials of $1,000, and I have $1,000 less cash. But the actual postings as we went along played out the way that I just illustrated. Now let's compare this with what is in your book. Well, I apparently can't open that. Let's see if I can find that. This is on page 64 in your textbook, and so I think I have a PDF of that. So give me a second to navigate to a place where I can open that up. Let's see here. Where is my PDF of page 64? There we go. Okay, so this is page 64 in your textbook, and it shows a scenario really similar to what we just did, and I'm going to have to make it a little bit smaller to get all of this to fit on the screen. And in the text, it gives you a scenario. But if we just look at the numbers that are there at the bottom, it says, okay, the first thing I did was I made a purchase from vendor 1. So in that situation, I make a purchase from a vendor, and it looks like I'm buying supplies. So I am debiting my, and I can't write on this PDF here, but I'm debiting my supplies account down at the bottom where you see the 1 next to it for $2,000, and I am crediting the appropriate vendor account, in this case vendor 1, by $2,000, which results in the posting down here to my accounts payable reconciliation account for $2,000. Then I pay, or excuse me, number 2, I purchase from vendor 2. This is a $1,000 transaction, so you see that as being the things that have the number 2 next to them. And then it looks like, just to beat us over the head with this, we go ahead and buy $4,000 worth of stuff from vendor 3. So you'll notice my supplies expense general ledger account here, I have debiting that, and then my vendor accounts, which are illustrated at the top, every time I made the purchase, I credited those accounts, which resulted in that being automatically posted to my reconciliation account in the form of a credit. The last 3 steps in this is where I pay for this. And so the 4 with the circle next to it is me crediting my bank account by $2,000 and debiting vendor 1's account at the top for that same $2,000, which results in the automatic posting to my accounts payable reconciliation account. So I wanted to show you this. This is the exact same scenario we just worked through with 2 exceptions. Your book is showing you this with 3 vendors, just to further illustrate the way the reconciliation account takes multiple vendors and has their transactions populate up to a single general ledger account. And your book has changed one other element, which is, instead of me buying an asset like lumber that I record in a asset account, your book is showing you expensing these purchases, which is another option here that we'll talk about more as we go along. But if I say to myself, these aren't assets, these are just things we're going to use in the course of doing business, it still results in a debit transaction, but it's now being a debit of an expense account instead of a debit of an asset account. So fundamentally, your book is illustrating the exact same thing here that we just talked about. Any questions about this? All right, well, let's forge ahead here. Oh, and here I was showing that if before I had $10,000 in my bank account, that now I actually would have $9,000 in my bank account as a result of this. Okay, so another scenario. We sell $500 of merchandise to Acme Anvils on account. So they're not giving me a check. They're not handing me dollar bills. They're telling us, bill us for this and we'll pay you. Okay? We'll do that. What are the transactions here? Well, this is a really important transaction and one that we want to see happening a whole lot in our organization. How does this play out? Well, here's the way. Let me give you the different accounts that are going to be in play. We have a sales revenue account, we have accounts receivable, and then we have the Acme Anvils customer account. Now, we could approach this many, many different ways. But let me tell you the way I like to think about this, and maybe it'll help you, maybe it won't. There is an asset involved in this transaction, and that asset is the money that is coming from my customer. But I don't have the money yet, but it is money that's an asset to me nonetheless because it's an account receivable. We already know that debiting an asset account means increasing the value of that asset. And the reason why I know that is because I like to see me debiting my bank account because that means I have more money. So Acme Anvils owes me more money than they did before. Them owing me money is an asset to me. Therefore, I know I am going to be debiting their account by $500 because I have just increased the value of an asset. That tells me that the offsetting transaction to sales revenue is crediting at $500. And sure enough, if we were to back up a few slides, we would see that crediting a revenue account means that I have increased the revenue value. And my offsetting transaction here is through automated postings of $500 debit to accounts receivable. Now, this illustrates something of critical importance that we will come back to later in the semester and flesh out further. But this also represents an area where, in the context of ERP SIM, a lot of students get really confused. And maybe some of you, even to this day, didn't really realize this. So let's talk about this. When do I incur revenue? I incur revenue when I make the sale. So when I made this sale to Acme Anvils, in my accounting records, I just booked revenue. My question to you is, do I have the money yet? No. So notice, revenue just went up, but my cash didn't change at all. A lot of times students mistakenly think that revenue and cash are the same thing, and they're not. Revenue and cash have a relationship, but in this scenario, no cash ever changed hands, and my revenue went up by $500. I don't know if any of you have ever had this scenario happen before, but a lot of times when companies are coming up on the end of a quarter or the end of a fiscal year, or potentially even the end of the month, there's a real effort for them to sell a lot of stuff, and they don't care so much whether they actually get the money from the customer at that point, but they know that if they sell it before the end of the quarter, it's going to be reflected in that quarter's revenue. So they make a big push to sell stuff so that in that particular quarter they can say, yay, we had record-setting revenue, even though they're not going to get the money until we get into the next quarter. Okay? And it's because we book revenue at the time of sale, regardless of whether money has changed hands or not as a result of that transaction. So we sell $500 of merchandise to Acme Anvils, and the postings are what you see it here. And you can probably guess what my next slide is going to be, which is Acme Anvil pays us. Okay? So what's going to happen here? Well, I am reducing, well, let's do this the easy way. I'm putting more money in my bank account. Debit my bank account $500. Therefore, I know the other half of the transaction has to be credits. And so I'm crediting the Acme Anvils account by $500, which is going to result in an automatic posting to accounts receivable for $500. If we bring together the last slide in this one, we will see that this leaves us with the fact that Acme Anvils owes us nothing. And in fact, our accounts receivable balance is nothing, presuming that we have no other customers and no other business going on. But I now have $500 more in my bank account than I had before this whole thing started. Which is illustrated by this slide right here. The ultimate outcome of Acme Anvils is $500 in revenue and $500 in my bank account. Okay, I'm going to ask you a particularly tricky question. What's my profit in this transaction? Don't know. We have no way of knowing. Notice what happened here is I sold this for $500. So my sales revenue is reflective of the amount of money that I collected from the customer. What I'm not seeing at all here is, well, what I sold that customer had value, which hopefully you know is reflected in cost of goods sold. Where's cost of goods sold? Not a part of any of the transactions we've talked about here so far. Okay? We have to add that more into our scenario when we talk about fulfillment. But I can't really tell what my profit is here. But for sure, my profit is not that whole $500 because I parted with something of value. Now, in the case of what we have here, Yeah. We're just looking at things based on selling price, and I wanted to make sure I had termed everything correctly as I did. So we're in good shape there. Let's talk about one more slide's worth of stuff, and then we'll be done for the day. And for right now, we're done with accounting posting. Have you noticed that in some of your transactions, when it's referred to the general ledger, you've seen new next to it, and it's talking about the new general ledger? Well, at some point, this term is going to have to change, because SAP did their accounting one way for a long time, and then they introduced their new, and you could put next to that, and improved general ledger. Now, this debuted in 2007, okay? So this is almost a decade old now, and I don't know at what point we stopped calling it the new general ledger, but you still see that in a lot of the transactions. This new general ledger allows us to do interesting things. It allows us to engage in parallel accounting, which means that companies can maintain multiple parallel ledgers, which essentially means I can have multiple general ledgers. Now, I always have one ledger that I consider to be my primary focal ledger, and we call that the leading ledger. And so any of my other ledgers are non-leading ledgers. Now, first of all, what does this mean? Well, this basically means that I can do a transaction and have it recorded one way in, we'll call it General Ledger 1, and a totally different way in General Ledger 2. Those two general ledgers are totally independent of each other, and one transaction is going to be captured in parallel in multiple ledgers reflective of the same actual financial event. Why do I need this, and how does this work, and what's the deal here? Well, the way this works is we have accounts in our operative chart of accounts, which correspond with our leading ledger, that is mapped to alternate charts of accounts reflective of other ledgers. Now, you might say, why in the world would a company ever want to do this? Let me give you a hypothetical scenario. Here's my company, and here's my chart of accounts. And for me, account number 100,000 is my bank account, and we'll say account number 300,000 is my accounts receivable reconciliation account, and I have a big old chart of accounts here. And that's my mapping to my general ledger, and I consider this to be my leading ledger and my operative chart of accounts. I buy another company, and I am now in the process of folding their operations into my operations. Well, to make my life joyful, they of course use a different chart of accounts. And in their company, their bank account is account number 30,000. And their accounts receivable reconciliation account is 127. And in fact, they might have some things in their general ledger that I don't have, and I might have some things in mine that they don't have. Well, what this allows me to do is I can say, okay, I'm going to have to go in and create translations here. And I'm going to have to say this account over here is the same as this account over here, and I'm going to have to create the association. And hypothetically, I might have one account over here that actually maps to a couple of accounts over here, and I'm going to have to create some rules as to which goes into which. That's what I can do with these parallel ledgers. I can bring this other company in, and I can set their ledger up in parallel, and now, because we're one company, but we each have our own set of books, now as transactions occur, I make the postings to my operative chart of accounts and to my primary or leading ledger, and it'll also be reflected in their books because now we're the same company, but it's going to go into different account numbers. And I don't have to think about that as the clerk who's actually doing the postings or anything else. But what's going to happen here is someone is going to have to set up these relationships here. And you could imagine if I'm a really big company, I might go out and buy, excuse me, 3 or 4 different companies. And I might therefore actually have multiple non-leading ledgers. And I use this as a way of kind of bringing all of that together.
One of those companies is international.
Ah, yeah, now we get into, they really should be in a separate company code because of accounting purposes and so on. Yeah, and we're going to have to handle it. And that's this right here. Sometimes I'm going to use this as a way of saying, okay, I bought a multinational, but some of their stuff is going to have to be reflected in mine and some of it's going to have to be elsewhere. And so I can do country-specific chart of accounts. I can also do some things like use this as a way of consolidating records across business areas. If I, for example, even though I report taxes for my 5 different company codes independently, I want to create a summarized income statement that shows them all combined, just so I know how well we're doing. This can help with that. There are other things I can do with this. If I want to make the move from GAAP to IFRS, and as a result of that, I want to change my general ledger, this allows me to create a new general ledger, map it to the old one, still have my transactions be captured, and then at some point I can switch them and make my new general ledger the leading ledger and make the other one a non-leading ledger. So this new general ledger gave us lots of different features. It gave us the ability to associate debits and credits with organizational entities, which means this says it facilitated cost accounting. It let me split documents. It let me have real-time reconciliation between financial accounting and cost accounting. And it supported this whole idea of parallel accounting with general ledgers. So back when I first started teaching with SAP was around 2007. When I would go to all the SAP conferences, it seemed like a lot of the presentations were about the new general ledger and the opportunities for your company. And sometime around 2010, those presentations stopped appearing because everybody made the transition. So you still see the terminology new general ledger out there, but it's really not quite so new anymore, and in fact is what most companies are running. Even if they're not doing the multiple ledgers and all of that, they probably are still using the new GL for the sake of the other benefits it gives us, particularly in terms of the interface between FI and CO. All right, well, we are out of time for today, so I will see you guys when we get together next week. If you didn't sign in, please make sure you come up here and do that.